mortgage companies, when you originate your loan, they make a decision, do they want to service the loan themselves or do they want to sell the servicing? Now, servicing is very, very different than the investor that owns the debts. So what happens is when you take out a traditional mortgage, and I'm talking about conventional Fannie Mae and Freddie Mac loans, I'm talking about FHA loans, VA loans, and USDA loans. When you take out a traditional mortgage, the bank you took out the mortgage with, even if they retain the servicing, they're not the investor. What happens is the loan gets packaged up into a pool. It gets the stamp of approval from that group, whether it be Fannie Mae, Freddie Mac, FHA, VA, or USDA, and then that pool is sold to investors on Wall Street. It's an investment that goes up and down in value based upon where interest rates are at and the return versus the risk. It's just like any other investment on Wall Street. So that's what the ownership of mortgages are. But the investor on Wall Street is not going to process your payment, is not going to be the place you call for customer service. That is your servicer. Now, many mortgage companies don't have the rights, don't have the licenses to service loans. So they sell 100% of their loans. Companies like Summit Funding, we have the rights to service our loans. We choose sometimes to retain the servicing immediately. When we close a loan, we choose sometimes to sell the servicing immediately. Why would we choose to do that? Honestly, it's no different than when you get your tax refund. And do you decide, hey, do I want to put that money to work immediately and buy something? Do I want to stick it into my savings account or do I want to put it into a long-term investment? Well, you could put it into a long-term investment that's going to pay you an annuity that pays you a little bit of money over a long period of time. And that's great in the long run, but you just tied up that whole tax refund money that you can't use for anything else. Well, that's literally what mortgage companies are doing is when they sell the servicing, they get a check immediately from the company that buys the servicing. If you retain the servicing, you get small portions of the payment every single month for as long as the loan lives. So retaining the servicing pays you more money over a long period of time, but you have to be able to meet payroll and pay for all your investments. And if you want to upgrade your infrastructure, you got to write a check for all of that stuff. And selling servicing is an asset that you can get a paycheck for immediately. So when your loan is sold, none of the terms can ever change. All of the terms that were agreed upon in the beginning will stay the same. Nobody can change your monthly payment. Nobody can change your interest rates. Your impound account is often reanalyzed, and that happens once a year, no matter if you stay with the same servicer, but often when they transfer servicers, they reanalyze the impound account to make sure you have the right amount of money coming into and out of your impound account. So the key, though, is understanding that even when companies retain your servicing, if they're not one of the top 10 mortgage companies in size, they don't have the scale. They don't have the number of clients for it to make sense for us to retain our own printing and mailing facility to mail out the statements. Doesn't make sense for us to staff a customer service line 7 days a week or however many days a week. It doesn't make sense for us to buy the equipment to process the monthly payments and the checks that come in. So companies like Summit Funding sub-service or hire an outside company to process the mortgage and do all the work for them. That's called a sub-servicer. So Summit Funding is not large enough to service all of our own loans. So we use a sub-servicer or an outside company, which makes it kind of silly because for the most part, a lot of our clients would get a letter after buying their home that says your servicing has been sold from Summit Funding to Summit Funding. Well, that doesn't make any sense. Technically, we owned the debt when you first took out the mortgage and we sold it to our sub-servicing company, even though we're the ones that still own the servicing. Well, sometimes sub-servicers will allow you to white label or put your name on the statements. And sometimes a sub-servicer's business model says, you know what? We don't do that. We think that it's smarter, they think that it's smarter to keep their name on the statement and not the mortgage company that actually owns the servicing, which makes it even that much more confusing. The bottom line is if you have questions about how servicing works, the first thing you do is call the 800 number on your statement and ask them, hey, are you my actual servicer, or are you sub-servicing it for my original lender? The only difference that makes is that if I was your original lender and it is with a sub-servicer that we own or we have partnered with, then I have a lot more control over helping you resolve issues. If it's not a company, if we sold it immediately, or sometimes mortgage companies will sell your debt sometime down the road. So they might service your loan for a period of time, and then they decide, you know what? I just feel like shifting my investments around, and I think that owning this group of loans is better off selling some of my loans and taking some of the cash right now. That often has to do with timing of where the market is at and capitalizing on when interest rates are super high, the value of servicing is worth a lot of money because people don't refinance. So mortgage companies will often sell their servicing when rates are high because it makes up for the fact that we're not making as much money originating new loans. I know there's a lot that I've gone over. Bottom line is servicing is confusing, but the simplest thing you need to understand is if you're one of my past clients, give me a call and I'll help talk you through it. If you're not one of my past clients, I'm happy to help you out anyway, but understand that your servicer is the one that handles the processing of payments, the setting up of automatic payment, the customer service. If you have issues working out, let's say you lose a job and you need help doing a workout arrangement, you need to contact the servicer who's on your mortgage statement. But when servicing is sold, nothing changes about your mortgage, nothing changes about your payment, nothing changes about your term. Hope that helps and have a wonderful day. Thanks. Bye-bye.